Hello, and welcome back to the Redhedge Podcast. This is one of our investment team's series episodes, and I'm here with Voon, one of our partners and portfolio managers. Hi, Voon.
Hi, Andrea. Happy to be here again. Always a good time to be back here.
As always, we are here to give an update to what is our view, in more than view, what we see happening around us, specifically in the credit markets, but generically in the financial markets. Sometimes, and we do a quick meeting before to do the podcast. We try not to prepare it. We keep it as natural as possible. But when Voon asked me, what shall we talk about? And I say, feels like a broken record, and we have to talk about how tight is the market, how little market is pricing any risk, and so we're back in, I guess, going in this direction. What do you think, Voon?
Yeah, 2024. Well, this whole Q1 24 has been extremely strong, hasn't it? Stocks back to the highs, credit at the tights, market, pricing in as though inflation is solved. We see in every market there was a lot of bullishness, basically, mostly in January and February. But in March, we saw that it's kind of the narrative or what the market perception has kind of changed a little bit, haven't we? We saw that market are starting to price in a lot less cuts in central banks. As we speak, I think there's only 3 cuts now priced in the Fed, whereas in the start of the year, around almost 6 cuts or so were priced in. So I would say the market has been a lot more buoyed up in January compared to now, even though spreads are continuing to be at the tights. In credit specifically, we also saw massive amounts of inflows and a lot of people who are really just yield buyers that are buying credit because of the yields and such credit spreads have tightened a lot. We think, or at least I personally think, that the levels here are starting to look very toppish, and I would even dare say a bit unsustainable. What do you think?
It was clear that we overshoot in December. Like on the rates side, it was, Bund below 190 and the 10-year point was a level that priced in a lot, as a curve as well, priced in a lot of cuts, which were very not realistic. At the same time, that has driven, since the CPI print of when was it, November, beginning of November, has driven the risk assets up and tighter in credit spread. What we see now is the momentum, almost the madness on the rate side has been priced back down to normal, to what is supposed to be healthy, and I've seen it as a healthy sell-off. And so what we're missing now is probably to go back to reality into the credit spread. As you did say, the key word here is about yield buyers. Yield buyers on credit are generating madness because they don't look at what is the historical credit premium that you get paid to buy risk. And I'm talking this both on high yield, IG, any in between. The idea is they just buy yield. And obviously, because the riskier issuer offers you a higher yield, doesn't matter if it compressing in spread between the two, they keep buying what offers a bit higher yield. This year we are a bit out of steam. Credit overall, equities keeps going in its own direction, and credit is not following as much. What I've seen is that the correlation has changed a bit in spread going tighter as much with a different ratio of equity going up. But I didn't see that yet in the riskier asset class. The ultimate completion, such as real estate, is still going up with the same magnitude that the equity is, because there is a lot of space in that direction. So bonds will go up points if equity goes up points. So the idea, the real estate is the ultimate completion, but how risky is that? We talk about a sector which is obviously having the most issue if they don't cut sooner. So we have this idea where everything is going to be fine in credit and in the economical cycle because the cuts will come. But the fact that they have postponed, the market itself is postponing when those cuts will happen, supposed to bring the sector of real estate a bit more back into the risk because it's less sustainable for how long? If we push it forward again, it would be sustainable for more, unsustainable for longer. And instead, market is jumping in this sector because it's the only one offering a lot of upside if everything goes back to normality almost. And I think it's very risky to me. Is now, we are, as Redhedge, putting more than average tail hedges of decompression and market to correct in credit because I think personally upside downside it makes sense, and especially if the cost of those hedges is very very cheap compared historicals, makes even more sense. Definitely there are some sectors that worries me more than others, and some asset classes that in general worries me more. But what do we have in front of us can move it? Like, given that I am convinced that we're trading at the wrong level for several reasons, risk is at the wrong level. What can bring risk back to normality, I think?
Wow, this is a tough one usually. I would say at the moment, I think the market is obviously very booed up, and therefore the market doesn't actually see much tail risks or any risk that could take us materially wider. But obviously these risks are just around the corner, because when we least expect it is when it comes out and hits us. Like we saw, for example, already that there could be single name issuers that would report poorly, and then the bonds could move points and points down. Like, for example, we saw with Altice this week, with other names previously as well. But I think the big elephant in the room is where that could take at least risk premium in global assets a lot higher is in a way inflation is going to head to. So inflation prints that we see at the moment has not gone down as quick as perhaps what the market has hoped, or perhaps what central banks have hoped. In fact, the last few inflation prints have been ticking a little bit up. So if this inflation prints start to accelerate, we also see inflation curves upward sloping as well, where the market kind of expects inflation to go higher in forward inflation. So if inflation starts to go a bit higher, central banks may now be forced not to even cut at all this year, be forced to pause for longer, or if inflation starts to accelerate, we could see another hiking cycle. And then what will happen here, back in credit, is that these yield buyers would then stop, as they would need to start and pause and think, okay, maybe duration isn't stable at the moment, and we would have to wait until yields are more stable before buying. And this lack of buying, combined with maybe some sellers and issuance, would then cause very quickly a change in the technical in credit, as we already saw even this month, because we've had 3 months of strong rally and credit is all to the tights. The room for compression and the room for credit spread upside is actually very little. And because the market is very buoyant, there are huge amounts of demand for issuances, and the new issuances can come with very or little or close to no premium at all. And all these deals has now started to look, a little bit weak because they've basically came too expensive, and the demand just isn't there for very, very expensive bonds. So, we've seen cash starting to weaken a little bit. I'm not saying at the moment everything still feels okay, but it only takes, it's okay until it isn't. And it takes very little to swing the pendulum the other way.
Because from this conversation, for me, it's very clear that higher for longer, the last October worried massively the market and driven the bonds 3% and the treasuries through the wides as well. The higher for longer was terrifying for this yield bias. The people that will be just buying the yield were selling bonds because they were freaking on the idea of having to wait for this trade to perform, and they hire for longer. How long? What does it mean? And this is one thing the market is not worried about right now. It is practically higher for longer. It is actually what they say that was gonna happening.
Yeah.
So it's practically higher for longer, but they don't care. Now we have single name defaults, or getting closer to them, getting pricing default for bonds going from normal to stressed. Not yet distress, but stress. We are in the stress situation. You mentioned LTs. There was a few more cases last week. No one cares. And what is a $1 trillion question. What else do we need to people to start to care? And it's very difficult, because what we had as well was the Fed meeting, and Powell he could choose to be dovish or hawkish, and decided to be a bull. He decided to be. I was shocked listening into him. It was very, very strong. It was very, very, more than dovish. It was bullish. We don't utilize these terms for central bankers, but I think it is appropriate for what they said, because they kept saying that we are data driven. It say that as well. But if I base the assessment on data, how can you say that you will cut soon? Like, he's strong with the communication that they said to us. It is a easing that we are used to central bank. Sometimes they took it wrong, and it wouldn't be the first time. You can't trade against them, but I would be very careful to be so bullish.
Yeah, here at Redhedge, at least for ourselves, we recognize the state of the market. The state of the market is that it is very firm, it is very buoyed up, and market participants don't really see any risk factors that could take us materially wider. But at the same time, we are also looking for value or relative value, and there isn't any absolute value. Over here, I would say the risk reward is extremely skewed. You could have days where, yes, we could potentially still grind into the summer. So you're chasing very, very the last tiny bits of performance, but something and anything could happen in this scenario.
Picking up pennies in front of the bulldozers.
Yeah. And we could have a random risk event or news flow that comes in, and then suddenly we would reprice, to a more healthy and a more sustainable level where the risk reward is therefore more justified, right? And it could be maybe an idiosyncratic default. It could be just inflation accelerating faster, like
geopolitical risk, which is always there.
Geopolitical risk is always there. It could be a recurrence of a banking crisis in the US. It could be a real estate sector suddenly now cracking again because now yields are higher. But it just also could be just a change in the technicals, right? Because yield buyers are not really buying when the yields, obviously they want high absolute yields, but not really buying when the yields are high. They're buying when the yields are stable, when rates fall.
When the rates fall is
low, which we may not get because when the rates are going higher, it's usually driven by higher inflation expectations or central bank hikes, which then increases rates fall, which then puts all these duration and yield buy on the sideline, which we saw actually last year around Q3 23, right? So these are all these risk factors that could happen, and I would be very, very careful here, and just basically the yields or the levels here are just simply the risk reward is unattractive to me.
Let's assess a different scenario. Nothing happens. So, everyone is pretty happy to pick up these pennies in front of this hypothetical bulldozer. Spread still goes a bit tighter from here. Obviously, there is a limit in bonds, which is the swaps. Like, you cannot be too much tighter from where the free risk is. No, you not get paid if you lend money to people. But there's the beauty of credit. The question is then, what happens next? Because everyone is just waiting for these cuts. Okay, let's say it's defined. Tomorrow will happen. What I strongly believe, that once the market will start to strongly price in cuts, and the cuts will actually happen, the market will sell off in spread because obviously the rates component will be massively tighter as expected, and the yield will be lower overall. The credit component will be potentially wider at the time, for my opinion, just because in a control in an anti-trend, people will be gradually take profit on their positions. So ergo the credit spread will go in wider. So I don't think there is a scenario where credit spread, I mean, no one wants to be short, and it would be a very strong trade, the pain trade to be waiting for this to happen, and it can take much longer than anyone would be able to attend. But I don't see a scenario where in a long term credit spread are sustainable at those levels.
Yeah, I would agree with you. I actually definitely do agree with you here. But it is possible for for the next couple of months that we still grind and nothing happens, because anything is possible in this market. And the market could just be, almost like a lazy long, and just because there are no news flows and nothing happens, it could stay like this and grind for a while. That is a potential scenario, which is particularly boring for most market participants. And but as we've seen in the past, the market never really travels in a straight line forever. Something usually happens, be it good or be it bad. Without a crystal ball, I wouldn't be able to tell you what could happen. Is that as when levels get too tight, any bad news can be a potential catalyst for a risk move a lot wider. But away from that, it's very difficult to predict, in the short term or even in the medium term what is going to happen. But we do know that there are some known deadlines. For example, the US elections will come later this year in November, which means we might get some noise ahead of these elections, like we saw in the last time around.
What is the good and the bad in that? Because last time around, the first time that Trump came around, obviously it was priced in as a very negative catalyst, having him as a president.
A wild card, wasn't it? Many people wasn't sure what a Trump presidency will look like.
Now it's perhaps a bit less because it's a known style, of course. Would it be still negative for the market having him back?
This is, for me, it is difficult to tell, I would say. I would say it might be, most likely, the market would still view it as small negative, mainly because it would introduce a little bit of uncertainty, a little bit of paranoia. So risk premium would come.
The trade war back, and so not good for the economy.
We might see an escalation back in the trade war. So we would see countries such as China or the EU or Mexico. We could see some uncertainty and some noise there. And because it might not necessarily be a negative news flow or a negative outcome, but if we get more uncertainty there, the risk premium naturally has to go up, and therefore credit spreads will have to widen a little, just to reflect some of this uncertainty.
The other thing that is driving the market, of course, in risk premium, which is less of our expertise and more what's something that we observe, is the new industrial revolution of AI-driven names, which we can really have an opinion, which is what is worth, but that is dragging equity, which is drags risk sometimes, keeps everything up together. I guess one other catalyst, I don't know if you agree, could be a bad quarter of Nvidia drives everything wildly down.
Oh, absolutely. I think this the S&P 500 really has been driven by a few names, what they would call the Magnificent Seven, isn't it? And because S&P and stocks and tech stocks are at the highs, it gives a perception that risk is strong and the markets and the economy is doing well, even though we all know that there is sometimes no correlation at all with financial markets performance and the actual economy. A fun fact as well is that in the film The Magnificent Seven, where these guys are named after, we know only 3 people survived at the end, right? In the old Western. So it could be possible that at some point the bubble or the frothiness of these tech names and the valuations that are placed on them might be challenged, especially like you said, if any of them, gets into a bad quarter or for some reason the perception or the hype on AI dies down a little. At the moment, we see
doesn't feel so for sure.
Doesn't feel so. Yeah,
doesn't feel so, but we need to be aware of it. It's something that, again, I don't see it as so tail, but as to almost be considered as a tail. Be aware of this fact, and to wrap it up, diversification, awareness. Be aware that buy credit today means buy rates, really, and so is a rates play. So especially for those investors which are less familiar with credit, there is to be meaningfully the meaningful level of attention once entering this sector today, in an outright way. Obviously, plenty of opportunity if you are a relative value or opportunity fund that I see differently, but I'm biased because we sell relative value funds. The key is outright long here. It is dangerous. It is a bit dangerous, for sure. Can be performing, but as upside, there are potentially less the downside for obvious historical reasons. So thank you very much, Voon, as usual.
Thank you, Andrea. Happy to be here.
And we will speak again in a couple of weeks.
All right.